Robinhood. The name alone pretty much sparked a revolution in investing. But after a truly record-breaking year, the big question is, has the revolutionary finally grown up and joined the establishment? Well, today, we're going to dig deep and find out.
Just look at this number for a second. $4.5 billion. That's what Robinhood pulled in for total net revenue in fiscal year 2025. That's a 52% jump from the year before. I mean, that's not just growth, that's an explosion.
And that really gets us to the heart of it, right? For years, everyone saw Robinhood as the wild child of Wall Street, the meme stock phenom fueled by pure hype. But after a year like this, a year of record profits, has it actually transformed into a real, durable financial company? And more importantly for all of us, is this the moment to invest?
Okay, so here's how we're going to break it all down. First, we'll look at the company's incredible transformation. Then, we're going to peel back the layers to see how it actually makes money and, where the dangers are hiding. We'll dive into the hard numbers, the ones that don't lie. We'll figure out what this company is truly worth and what the future could look like. And then, we're going to give you our final verdict. We'll even look at some other options if Robinhood feels a little too risky for you.
So, let's start with that transformation. And let me be clear, this is not the same Robinhood we were all talking about a few years ago. What we're seeing is a company that's actively trying to move on from its wild past and build something much more stable, much more diversified. And hey, don't just take my word for it. The company's own CFO, Shiv Verma, basically spelled it out. He said they set new records pretty much across the board. So this wasn't just a lucky break in one area, it was a fundamental shift in how their entire business operates. But of course, these incredible numbers didn't just appear out of thin air. So for this next section, let's pop the hood, no pun intended, and take a look at the engine that's driving all this growth. We've got to understand how they're making their money, and just as important, where the biggest cracks in that engine might be.
Now this chart right here is the key to understanding the new Robinhood. Yeah, okay, transaction fees are still the biggest piece of the pie at 59%, but look at that other slice. That 34% from net interest revenue. That's the boring, steady, predictable income that the old Robinhood was missing so badly.
But that big slice of transaction revenue brings us straight to the first major risk, market volatility. When everyday traders get nervous and sit on their hands, Robinhood's earnings can swing a lot. The second big risk is leverage. Their debt-to-equity ratio is pretty high and something called their Altman Z-Score, which is basically a test to predict if a company might go bankrupt, is in what experts call the distress zone. To put it simply, they're carrying a lot of debt, and that always adds risk.
And look, just to prove it's not a perfect story, we have to talk about this recent stumble. Even during a record-smashing year, they still managed to miss their revenue target in the fourth quarter. It wasn't a huge miss, but it's a really sharp reminder that when your stock is priced for perfection, even a tiny slip-up can get you punished.
Okay, so we've got the business model, we see the risks, now it's time to drill down into the hard data, the numbers that really paint the true picture of Robinhood's financial health.
This table right here, it really tells the whole story in just 4 numbers. First, you've got that insane 52% revenue growth. The top line is just on fire. Second, that 86% gross margin. Wow, that's incredibly efficient. It means for every dollar in sales, they're keeping 86 cents before other expenses. Third, that debt-to-equity ratio just confirms the leverage risk we talked about. But that last number, the 76% jump in adjusted EBITDA, that might be the most important one. It shows that Robinhood is becoming an incredibly efficient profit-making machine.
So the company's growing like crazy, and it's super profitable, but it's also carrying some serious risk. This brings us to the million-dollar question for any investor. What is the stock actually worth today, and what could possibly knock it off course? And believe me, the debate over its valuation is fierce. On one side, you have people saying the stock is just too expensive. It's trading at over 8 times its tangible book value, which is more than double the industry average. But on the other side, the bulls point to something called the Rule of 40. It's a quick check for high-growth companies. You add the revenue growth rate to the profit margin. Anything over 40% is considered elite. Robinhood's score is a jaw-dropping 111%. That, plus record earnings, makes a pretty powerful argument that this stock deserves to be treated like a top-tier tech company.
It's really no surprise that Wall Street itself is completely split on this. As you can see, you've got big players like Barclays and KeyBank with strong buy ratings, thinking the stock could go as high as 171, but then you have heavyweights like JP Morgan and Morgan Stanley saying, hold on, with hold ratings. It's a huge sign that even the pros can agree on where this stock is headed next.
Now, looking ahead, there is one giant storm cloud on the horizon that could affect not just Robinhood, but the entire industry. If the Federal Reserve starts cutting interest rates in 2026, it's going to squeeze those profit margins on all that net interest income. It's a major headwind that everyone is watching very, very closely.
All right, we've laid out all the evidence. The incredible transformation, the business model, the risks, the valuation debate. Now it is time to put it all together and make a call.
So after weighing everything, our recommendation is clear. Based on all the available data, we're calling Robinhood a buy. The company has truly navigated a very tricky transition, and it now looks to be in a real position of strength.
And we're not just saying buy, we're putting a number on it. We are issuing a 12-month price target of $147 per share. We believe the company's powerful growth and rapidly improving profitability are more than enough to justify its premium price tag, even with the risks we've discussed.
So here's the bottom line. It all comes down to this trade-off. The strongest argument for buying is that Robinhood has pulled off an amazing transformation into a diversified, profitable powerhouse. The biggest risk you're taking on is that its success is still tied to the unpredictable whims of retail traders, plus the financial strain from all that debt on its books.
But hey, I get it. Maybe Robinhood's risk profile is a little too spicy for your portfolio. If that's you, don't worry. We've got a couple of other ways you can play the brokerage space that are a bit more on the defensive side.
The two obvious alternatives are Charles Schwab and Interactive Brokers. Schwab is the 800-pound gorilla in the room, the established giant with better tools for serious traders. Interactive Brokers is another old-school player, and they're really known for their appeal to more sophisticated, professional-level investors. Both give you a piece of the same industry, but with a much more conservative risk profile.
Ultimately, Robinhood has proven it can grow up, turning from a wild cultural moment into a true financial force. The risks are absolutely real, but you just can't deny the momentum. The only question now is whether it can become the dominant financial platform for the next generation. So let us know in the comments what company you want us to put under the microscope next. We'll see you then.